You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. 15 programs for you guys to consume wherever or whenever you are coming in live after the fact. We welcome you all. The easiest place to get all of that great content, as well as a lot of great written stuff, too, is over there on the mothership, the flagship, theoptionsinsider.com. You can always mainline the radio, read some breaking news from the options market, a lot of unusual activity, breakdowns of all things VIX related and other fun things in the volatility arena, education, you name it, it's up there in some capacity. If you just want to hardcore mainline the radio via your usual outlets, well, we're up there as well. iTunes, TuneIn, Stitcher, Google Play now, as well as iHeartRadio is coming online over just a couple days ago as well. So always adding new fun outlets. So if you're out there on iHeartRadio, you want some podcast action, we're there for you as well. And of course, you can always grab us via our mobile app available for iOS, Android, and the beloved Fire OS. All right, and joining me on the old program today, let's go in order of proximity again. So I got one person who's right next to my elbow, so we'll start with him. Usually he's somewhere hither and yon. He's off in the forests of Canada or the harbors of Asia or somewhere else, maybe the plains of Oklahoma. Today he's right next to me, enjoying the fine, lovely beverages here in the studio. Mr. Russell Rhodes, the senior instructor over there at the Options Institute, and just volatility man about town. Mr. Rhodes, welcome back to the Volatility Views program, and welcome to the Options Insider Studios yet again, sir.
Actually, I prefer to be right here next to you, right next to your left elbow.
Don't we all?
I'm actually on vacation, therefore I'm not supposed to go into CBOE, so in order to broadcast, I have to come to you today.
There you go. So you're playing it a little fast and loose with the rules. We like that. A little edginess here on the old Vol Views program. And a little bit farther out from, well, we'll find out where he is. Either he's in the Option Pit World HQ down here in downtown Chicago, or he's out there in scenic and lovely, nay, even historic Riverside. We are joined by the greasy meatball himself, Mr. Mark Sebastian, from OptionPit.com, as well as a few stops over there by way of Carmen Line Capital. Mr. Greasy Meatball, welcome back to the program, and where are you beaming in from today?
I'm enjoying the beauty and green atmosphere developed and designed by Olmsted in scenic and historic Riverside, Illinois.
It is indeed scenic and historic. And we are also joined by a great guest. So let's just get right to it then and dive right on into our Volatility Viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody. Welcome to the Volatility Viewpoint segment. Like the man said, this is the portion of the program where we welcome on guests, traders, thought leaders, executives, analysts, researchers, etc. from throughout the world of volatility and then proceed to pick their brains for the benefit of you, the listener. And today's guest is a newcomer to the program. He is Ricardo Manrique. He is the Executive Director of Index Management and Derivatives over there at MSCI. Ricardo, welcome to the Volatility Views program.
Hi, Mark. Thanks for having me on. I'm sitting over here in downtown New York, the center of it all, or center of some of it, and happy to join you guys on the podcast and talk about a little volatility, a little international markets, a little equities, et cetera, et cetera.
Yeah, it should be fun, and I'm looking forward to it. I know a lot of our listeners are probably asking themselves, hey, MSCI, I'm kind of familiar with that, but maybe not as much some of the other ones out there. So maybe we'll start there. And also, because it's your first time on the network, we'll start with you as well, as we always do with our first-timers here on the program and indeed on the network. Why don't you start off, give our listeners a little bit of an overview of your background in the options and derivatives markets, and then how you found your way over there to MSCI, as well as, of course, a nice little overview of MSCI as well for all of our listeners out there who may not be familiar with what you guys do.
Sounds good. So I'll start with myself. So I've got about close to 20 years experience in the derivatives markets and the index business. Started out initially working for Dow Jones indexes way back in the late 90s. Helped set up the stocks index business over in Europe when the introduction of the euro was happening back in 98, 99, and was there for a couple of years. Then I went on to the sell side and worked for a couple of banks in both London and New York, working in the structured products business as a derivatives salesperson and structurer and trader across all the asset classes. Started out in credit and rates, then moved over to equities, did some commodities, did some currency as well. Then about 5-6 years ago, was living in Europe, and we decided to come back to the States and hooked up with MSCI, which we are based here in New York. And I'll get into a little bit of MSCI in a second. And been here for about 5-6 years, and like you mentioned, have been really focused on helping MSCI build its footprint in the derivatives business, and we're doing a lot of work with a lot of global derivatives exchanges, including the CBOE, who we have a great relationship with over in Chicago. In terms of MSCI, so very, very quick overview. So MSCI, we are a large equity index provider. We also have a large analytics business as well, where we provide platforms and tools for risk management and portfolio analytics. Historically, our footprint has been in the international equity index space. So really at the core of what we do is we help investors globally look at and access and research and navigate the international equity markets across the globe. And they do that using our tools, using our index data, using our indexes, and to a large extent using financial products in the markets that are linked to our indexes. So we calculate close to 200,000 indexes a day. We have a lot of well-known international equity indexes that are used as benchmarks by asset managers, by pension funds, and we'll talk a little bit about those probably on the segment. Two of the bigger ones that I'll mention are the MSCI Emerging Markets Index, which covers 23 global emerging markets equity indexes, which that index itself probably has about $1.5 to $2 trillion of assets that are benchmarked or actively benchmarked or passively tracking that index. And the other one is MSCI EFA, which is Global Developed equity markets excluding North America, so excluding the US and Canada. And that index has probably close to about 2 trillion in assets that are linked to that index globally, from pension funds, asset managers, et cetera, et cetera. And then the last thing I'll mention is just as an index business itself, I think now we've got probably in aggregate about 10 to 10.5 trillion dollars of assets that are linked to the MSCI equity indexes. So as you can see, we have a pretty big footprint in the international equity markets, and we work with literally every pension fund asset manager from Japan down to Brazil, across every country, every region, and my focus specifically has been working with global derivatives exchanges and helping them develop and create listed futures and options markets on our international equity indexes. So that's a kind of a quick summary. So hopefully that helps paint the picture a little bit.
You painted a vivid word picture there, Ricardo. But it's interesting. The MSCI, obviously a big player in the index space, particularly in the international space. But as your title indicates, and the reason we have you on today is, of course, MSCI making a big inroads these days into our neck of the woods, the options and derivatives side of the fence as well. There are quite a few derivatives products out there on a variety of different MSCI indexes. In fact, you guys not too long ago, I should say, announced a partnership with our other friends over here, including my buddy over here sitting to the left here, the CBOE folks, partnering on a lot of different indices to disseminate the data, and then, of course, because it's CBOE, also listing options on those. And the two big ones right now, MSCI Emerging Markets, like you were mentioning, as well as EAFE, EAFE. If you're wondering yourself, what the heck is EAFE? EAFE, it stands for Europe, Australasia, and Far East. So that's lots of mouthful. Like Ricardo said, just think of it as pretty much every developed market outside of the U.S. And that's something I know a lot of our listeners are interested in. We'll get to that in a little bit as well. But we're always so focused here on domestic stuff, Russell. We're always talking about, VIX and S&P 500, vol, and everything like that. It's always been a sticking point, I know, for us and for a lot of our guests and listeners, that the international alternatives, the international flavors of volatility are so few and far between. I mean, you have your V stocks over there. You have your India VIX, which does print every now and then. We do talk about that a bit on the show. And aside from that, there haven't really been a lot of other players out there in that realm. So that's one of the reasons why we wanted to have you guys on here today. Talk a little bit about your partnership and also kind of hopefully opening the doors for a lot more people to come in and start playing in international vol. I particularly remember this back in the whole Ukrainian episode with Russia there a little over a year ago, where we had so many listeners writing into us and just saying, hey, how can I play? I like VIX, but VIX is way too U.S. centric. I really want to get hardcore into European exposed type volatility. And there wasn't a lot of options out there, pun intended, and literally. I mean, you have your B stocks, obviously, and that was kind of really the only game in town. And even then, that wasn't doing a lot of volume. So it's always nice to have some other options, pun intended, out there. So let's get into that, Ricardo. Let's talk a little bit about why you guys are, I'll let you explain it for our listeners rather than me. Talk a little bit about what you guys are planning in the derivative space, why breaking into the derivatives realm is so important to you guys, as well as why you're partnering with the CBOE and what you guys are actually cooking up over there.
Yeah, no, that's there's a lot of material there, and we could probably spend hours talking about this. But so basically, I think if you look at the global markets and you think about what are the big trends that are going on, there are, I'd say, probably two main trends. So one is the increasing move towards passive investing, and that's been the big trend that's going on now for a couple of years, and it's gaining more and more momentum as time goes by. And then there's also the big trend, which is the increasing internationalization of equity investing. So if you think about at a high level, most institutional investors, most large investors historically were more or less limited to investing in their home market. So if you take the typical Japanese pension fund, they would put most of their equity investments into Japanese equities. A typical U.S. pension fund would put most of their equity investments into U.S. equities. And that's really changed over time. So that what we call the quote unquote domestic home bias of of investors has increasingly diminished over time, and allocations to international equities have increased. And that's that's a big driver of the large asset base that is tied to our indexes globally, and just a byproduct of that is, as there are more investors and assets and flows going into international equity markets, then as a direct byproduct of that, the market and the market participants need the risk management products in order to either risk manage their positions or implement their views. So what we've been doing on our side is, over the last couple of years, really working with a couple of exchanges, and we've got a great partnership with the CBOE, and we launched options on MSCI emerging markets and MSCI EFA probably now about a year and a half ago. And that's really the whole gist of it is we were increasingly getting demand from investors to put products into the market that they could use to manage the work that they're doing around international equities. And specifically with the CBOE, they've now got MXEA and MXEF, which are the option symbols for those products. And that's the reception has been really good. And we're in the process of helping them develop those markets, and they're doing a lot of the groundwork in terms of educating investors and really helping to build liquidity and drive usage. And we're really happy with the partnership that we've got with these guys, and they've been a great facilitator of getting these products off the ground.
Well, of course, here on the old Vol Views program, we're big fans of all things volatility. And I know, Russell, I can see you typing furiously away over here, and that's why it's nice to have you in the studio. I know you're doing a deep dive into all things MSCI VIX, because, yes, there are some MSCI VIXs out there. In particular, we're talking emerging markets, and CBOE does put out the VXEEM, which is, of course, the CBOE Emerging Markets ETF Volatility Index, as well as VXEWZ. You guys know EWZ. We've talked about that one before out here as well. So a couple of different volatility products. I know, Russell, you like to look at a broad swath of volatility indices out there when you're writing up your blog and doing a lot of research. So walk our listeners through these. We always talk, OVX as well as regular VIX and GVZ and things on the show here. Let's talk a little bit about these emerging markets volatilities as well. What do they cover? What do you watch them for? And what's some of the utility to some of our listeners?
Well, with MSCI we're talking about the index options, but using the options off of some of the more actively traded ETFs, we actually calculate some VIX indexes that are non-U.S. stock volatility indexes, and we've got the EFA one, which is you didn't mention that one when you were doing the lead into the question, but yeah, that I love. I can never remember exactly what EFA stands for, but I think the explanation that it's every developed market outside of North America is a great visual of that one. And when you have something going on in Europe or something going on over in Asia that's more market specific to those parts of the world, I like to take a look at a VX EFA versus VIX and actually put them together as sort of a ratio. A couple of weeks ago, the biggest mover amongst our volatility indexes to the upside was actually VX EFA, even though VIX and all the U.S. volatility indexes were down. So I think that's a good indication right there that if you're trying to hedge some sort of global equity exposure, the S&P 500 gives you global exposure, but can be quite a disconnect between the international markets and the domestic markets. And then VXEEM, the same thing. It's a great way to, with VIX, VX EFA, and VXEEM, you basically can look at, three major asset classes relative to each other. U.S. stocks, developed non-U.S. stocks, and then emerging markets, and see where people think the risk is. And I think that's been one of the best uses, at least being a volatility guy and all that I can come up with respect to working with MSCI.
I'm looking here as you were talking at the chart for VXEEM. And it does kind of follow a similar progression to as you might expect for when we talk about domestic VIX here all the time, kind of relatively tranquil, at least not in the early part of the year, but after that kind of relatively placid. Then, of course, obviously with international vol exploding in the wake of Brexit, we saw a huge spike into that June, July timeframe. Then, of course, like everything else, kind of coming off a bit again. It spiked up to as high as looks like a little bit over 30 back in late June, early July. And now, of course, as of today, VXEEM coming off, as you might imagine, everything, all the vol coming off ahead of the weekend here by about 1993, off about a point and a third so far today. So interesting developments out there from an international perspective. Mark, I know you're primarily focused on domestic and VIX and all things S&P implied volatility, but I know you keep an eye on international products as well. I'm curious your thoughts on the indicators like a VXEEM as well as some of the other MSCI indices they have floating around out there and the indicators and options floating around on them. How do you incorporate those into your analysis on a regular basis?
I think if they can figure out the underlying, there's going to be heavy demand for this. I think one of the things holding this thing back is that they don't have a U.S.-based future. So we'll have an index, but I'd love to see CFE or CME list a tradable future against these index options, because I'll tell you there's heavy demand for a cash settled version of these European style version of these trades, so that you have less volatility in terms of dealing with the dividend, dealing with early exercise, dealing with some of the tax consequences of trading EM and EFA itself. It's also the big multiplier there would allow for, I think, some true institutional trading. I really think there should be some demand. We see that SPX does just massive volume, and then it doesn't hurt SPY. If anything, the two help each other. How do you see things playing out between the two, EFA and MXEF and EM and MXEM? And is there a plan to potentially list some sort of future on the index? And then, or the alternative would actually be to do some sort of cash basket, but that might be difficult.
Yeah, so those are all good questions, and I think that kind of it's interesting because Mark, you kind of hit the nail on the head as far as what we're trying to do, and it's always you guys are very close to derivatives markets, and so obviously the CBOE being the derivatives exchange itself. I think any launching new derivatives products and making those products successful and getting liquidity and it's definitely an uphill battle, and I would say a lot of products are launched globally across exchanges that never really materializes. And just as that's why we're very happy with the CBOE, because they've done a great job of helping to get MXEF and MXEA off the ground. But I think probably like 90% of the battle is getting the information and the awareness and the visibility out there. So maybe I'll just step back for a second and try and paint a little picture of the product spectrum, because I know we tend to toss around a lot of acronyms and ticker symbols. So let's start on the high level. So at a high level, we have the MSCI Emerging Markets Index and the MSCI EFA Index. As I said, the MSCI Emerging Markets Index covers 23 global emerging market equity exchanges, and MSCI EFA covers global developed, excluding North America, which is 21 countries. Now, those indexes have ETFs on them, which are the EFA index has EFA, which is the iShares MSCI EFA index-linked ETF, and the Emerging Markets Index has EEM, which is the iShares ETF. Now, those ETFs have options that are multi-listed across all the U.S. options exchanges, and those are the options on EEM and the options on EFA. And as Russell was saying, there are VIX indexes that are based on the implied volatility of those ETF or those options on the ETFs. Now on the index side, now we've got MXEA and MXEF, which are the index-based cash-settled versions of the indexes, or the options of the indexes. And I think, Mark, as you were talking about, those have they have different dynamics relative to the ETF options, or the options on the ETFs. So they're cash settled. They've got larger multipliers. There's also Russell probably knows better than I do, but there's the different tax treatment between index-based options and options on ETFs. But then, Mark, specifically to your point, so there are futures that are listed on the MSCI Emerging Markets Index and on MSCI EFA Index. And those futures are listed on ICE in New York, and they're actually pretty liquid. So the futures on the Emerging Markets Index probably trades now. I don't have the numbers in front of me, but I want to say that that's probably trading about $3 to $4 billion worth of notional per day. And the futures on EFA are probably trading about $2 to $3 billion worth of notional per day, and those numbers have just been going up by super high double digits over the last couple of years, and that's primarily the reason that we were actually able to work with the CBOE and get the index options out there, based on the fact that there are futures markets out there that allow for the hedging and the offset for the market makers and other market participants. But to your point, Mark, it's interesting that a little bit the battle that we fight is trying to get the information and visibility out there, because not everyone knows that there are futures out there, and still not everyone knows that there are options out there. So hopefully that kind of paints a little bit the picture of the spectrum of what's out there, and ultimately what we'd like to do and what we'd like to work on with the CBOE is, as we get these options markets developed, we'd love to then be able to translate that into the possibility of creating, pure sort of VIX style indexes on EM and on EFA that align with the way that the CBOE looks at implied volatility and is based off of the cash settled indexes.
Yeah, I noticed.
Does that make sense?
Now I'm looking at that. That's really fascinating. I think there's going to need to be some broker education in that as well, because there are some large funds, mutual funds, whatnot, that could really benefit from using these products as opposed to the ETFs, and then getting enough market participants to tighten this thing up, knowing that there are futures there, should make things a little easier. So yeah, I mean, it's really fascinating. VX, I know for a fact that there are people that look and are interested in trading VXEM and VXEWZ, having something that's based off something a little more stable and as a cash settled and has similar characteristics to the cash settled S&P 500 options, might make that future and that more palpable potentially, because there are just some idiosyncrasies with afternoon settled versus morning settled and the whole 9 yards. So it's definitely that should pique some people's interest. Let's just say that.
Yeah, I remember when we had we had an initial meeting and we were kicking this around when CBOE, before we started the broadcast, when CBOE and MSCI teamed up together to launch those index options, and we actually went through the futures, and I was honestly kind of surprised at how liquid the futures that are associated with those index options were. I like to think that I pay an awful lot of attention, but I was pleasantly surprised to see that the futures are there. They trade particularly well, and that's what allows the market makers in the specific index options to quote fairly liquid markets. And there have been a couple of size trades that have been put up that the public customer that called them in was happy enough with the pricing that they actually did execute in that market. So liquidity begets liquidity, and we definitely have it in the futures that are associated with the index options.
I kind of wonder if we're getting so deep into the nuances. I'm looking here at some of the live comments, and maybe we're getting a little ahead of some of our audience, because one person, a couple people actually chiming in saying, "Hey, isn't S&P 500, SPX, and SPY, and those, aren't they mostly international as well?" And there's a point to be made there. Obviously, these are most, particularly in the top 100, these are mostly large international conglomerates that have a lot of currency exposure, international exposure. They're headquartered all over the world, but still, when it comes down to, at the end of the day, the driving force for most of these companies is the U.S. economy. But maybe, Ricardo, maybe we should jump into that a little bit too, because clearly people are curious. I mean, you're talking about fighting the battle for MSCI and getting the awareness out there. When it comes to these international indices, maybe also let's talk a little bit about some of the use cases, the performance, how they really differ from, like some of our listeners are saying, isn't S&P 500, doesn't that already give you a lot of international exposure? So maybe what, in your view, you've been watching these for a long time, you deal these products every day, what is the exposure difference, the performance difference with some of these, let's say the IFA or some of the other indices versus, let's say, a traditional S&P 500 position?
Well, Mark, just as a note, I mean, I think just because you derive a lot of your sales from an international, the international space doesn't make it the same as being an international company. There's all sorts of regulatory, government, all sorts of changes in risk for companies that are headquartered and do, the majority of their business in and around their home country. So you think about it, like the big comment is, okay, well, half of the S&P 500 sales are global. Okay, well, half of them are still domestic. So if you're dealing with a big international company, they could have still half of their sales could be in Great Britain, or half of their sales are in Germany. That is still a dramatically different dynamic than in terms of the international flavor than what you would get out of, General Motors or something like that.
Yeah, and as I was kind of trying to make a similar point when I was talking about VX EFA and VX EEM relative to VIX, and how many we see some dramatic differences in performance, even on a daily basis, based on risk perceptions for developed markets outside the U.S. versus the U.S. And to even take it a step farther, I spend some time looking at, for a completely different reason, looking at the FTSE, the Eurostoxx 50, the Nikkei, and the S&P 500. And for a blog about Warren Buffett, I put up a chart of the performance of those four indexes going back to the beginning of 2007. And there have been dramatic performance differences among those four indexes. And EFA would be the other three relative to the S&P 500. So, the business trends are probably somewhat similar with the S&P 500 and EFA, but EFA is going to have more exposure to international markets. There's going to be different currency risks that hit those guys, and with respect to EEM. We were doing a thing at CBOE this week where we had in a bunch of students that are doing an executive MBA program at Northwestern, and there was a group of them from Brazil, and they noted that basically when you are thinking about investing in the Brazilian market, you're really just trying to decide how stable you think the political environment is going to be. And needless to say, that has very little to do with stocks in the S&P 500.
Yeah, you're right. It's easy to think of some of these names because they are considered broad international conglomerates, that they are international. But yeah, you're right. Just because they have sales overseas, or maybe a tax headquarters overseas, or a variety of other issues overseas, doesn't mean they are a international firm in that perspective. And certainly your point, Russell, about how a lot of these other areas of the world have a lot of different exposures and risks and volatility that we just don't have here. And so you need a true international product, international index to track. Is that hurricane making its way up to New York, Ricardo? Is that what's knocking you off here?
Oh man, having a tough time today. I think I'm back on. Sorry about that.
I think you're back. So we just had a long conversation about some of the differences, S&P 500 volatility and domestic company volatility and performance versus international. I'm sure you have a lot of thoughts on that as well. So have at it before the hurricane wipes you out again.
Yeah, no, it's really interesting. It's been super interesting to see how the volatility has evolved over the last couple of years. And especially in recent months where we've seen, I was looking at the realized vol, and it's just been a dramatic drop in across the board in Europe and the U.S. and from where we were just a couple of months ago. But even then, like I think you still see a pretty decent divergence of volatility, especially, and I'm talking about realized volatility between, say, for example, the U.S. equity markets and the emerging markets. So I think in terms of realized vol, if my math, which is a bit rusty, is correct, I think U.S. realized vol is probably down towards the 5% number these days, whereas emerging markets is still up towards the 10% figure, both dramatically down since recent times. But then also, I think when you kind of flip that a little bit and look at the performance, I think we've seen, especially this year, a pretty big divergence in terms of performance of the market. So if you look at, for example, I think emerging markets year to date is up around 12%. Whereas U.S. is up around 6%, and EFA is down about close to 1.5%, largely on the back of decline in the European markets, which are down probably about 3% this year. So I think it's interesting to see how there's been a divergence in the performance of the markets, and EM seems to be, historically, EM has relatively underperformed over recent years, but this year is definitely racing to the top, and I think you've seen that flow into the divergence of the volatility.
Well, Ricardo, I know you have to run in a little bit, and we keep rolling with our program, but I do want to cheat a little bit. We have some questions here. This question here came in from a listener, goes by the handle Vic Tom or Victim, I'm not sure. He or she, this is a perfect one for you before you head out of here. It's right up your alley. He asks, I like VIX, but it's primarily domestic. What are some good resources or products for exposure to international volatility? I'm going to go out on a limb, Ricardo, and say that you may have some answers for our friend here, Mr. or perhaps Mrs. Vic Tom.
Yeah, so and Russell can probably chime in as well, but definitely I think with obviously you've got the options on the ETFs, which are out there and are super liquid. So those are the options on EEM and EFA. Now you've got the cash settled options, or the cash settled versions, which are MXEF and MXCA, and that's on the back of our business development that we're doing with the CBOE. And as Russell mentioned, you've got the actual implied volatility indexes on EEM and EFA. And I think longer term, what we'd like to do, if we can make that happen, is get the markets on MXEA and MXEF developed, and roll that into the possibility of creating VIX style indexes and VIX style products on the cash settled versions of the indexes, which then create that whole ecosystem that's tied back to the index-based futures and potentially volatility-based futures. So longer term, I think going back to some of my initial comments was that as more dollars continuously flow into international equity markets, that creates a need for tools for investors to be able to risk manage those positions or take views, and I think that's kind of the next phase of what we're seeing happen in terms of the development of new listed futures and options products. Is really, we've got many products on domestic equity markets around the globe, and now we're really working hard to develop products and give investors the tools they need on international equity markets.
And We've got VIX, which gives you the pure, S&P 500 volatility. But before VIX, and even today, if you're trying to do some sort of trade based on your outlook with respect to a market's volatility, you can still do those sorts of things using the options on the EFA ETF, or the options on the EEM ETF, or the index options as well. So even though we don't have derivatives based off of any of the four non-U.S. stock volatility indexes, there are ways to go about doing those sorts of trades.
And I think that also goes back to the previous comment that I think at this point, a lot of market participants, they know and they get what's available and what's happening with regards to domestic markets. But I think there's still a lot of work to be done in terms of education and just letting people know what's already out there and what we're trying to do with regards to international equity markets.
Well, Ricardo, I appreciate you jumping on, you braving the impending hurricane coming your way to join us here on the old Volatility Views program today. And before you hop off, if our listeners are intrigued by any of the stuff we're talking about here, it could be VX, EEM, or could it be any of the other, IFA, or any of the other MSCI derivatives / volatility type products you guys are cooking up, where should they go? What should they do?
Yeah, thanks. Certainly from a product perspective, CBOE is the best place to go. So on the web, CBOE.com, and talking to the folks from CBOE, they can help you navigate exactly what's out there. From the index perspective, our website, www.msci.com, tons of information out there on the web in terms of what the indexes are, what's the performance, what's in them, and as well as contact information for people in our offices in Chicago, New York, and other places. So definitely looking forward to helping to increase awareness around what we're doing, and really appreciate the opportunity, Mark, for having me on the podcast.
Well, we're glad to get you on. We're hoping to have more insight from you guys over there at MSCI coming down the road, because quite frankly, it is an area we get asked about a lot. They want to know about international volatility, our listeners, and they like all things domestic, but occasionally, once or twice, things occur beyond our borders that may or may not be very well reflected in the traditional products we talk about here. So if you want to learn more about those products, listeners, CBOE has a microsite you can go check out. Just search for MSCI and CBOE, and you'll get a link to that page right away. That explains all the CBOE products that Russell and Ricardo were talking about. If you want to learn more, obviously, about the MSCI, head on over to MSCI.com, a wealth of information about all the different products they have available for you over there. Meanwhile, though, we're going to keep on rolling right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. We had a great conversation about international vol. It always goes long when we have guests on, but we like that. It's a good sign. It means it was a fun conversation. And, of course, an interesting week to look back on from a volatility trading and research and analysis and developments perspective. Like I mentioned at the top of the show, we are streaming live and recording this on Friday, September 2nd, for all of you playing at the home game, close to 1 p.m. Central here now, coming up on the end of the show here. And we are, of course, coming off the heels of the big non-farm payrolls announcement. The last few non-farms have been somewhat surprising, shall we say. So after being kind of a bit of a resounding meh for the better part of the past couple of years, non-farms really not being the big driver it used to be, the last few cycles have suddenly turned that on its ear, and everyone's paying attention to non-farms again. Of course, Miss Yellen and her crew are contributing to that by saying they're being very data-driven, and they're watching the non-farms very closely as well, so therefore everyone else is. We had the number come out this morning, and a lot of us were prognosticating on last week's show what's going to happen with vol post non-farms. We thought it would come in, and a lot of us thought it would come in maybe a little bit more aggressively than it has right now. As we're recording this right here, a little bit after midday Central here, vol VIX cash off about a point or so, hovering right around the 12.5 range. So coming off, but still fairly elevated especially when you compare it to recent realized vol. We had a couple of days of action there, but otherwise, historical vol 30 days still in that 5 range. So not a lot of vol to be had out there, but a lot of interesting stuff to talk about nonetheless. Mark, we're coming up against it, so I'll toss it to you, and you can have at it. What's been catching your eye this week from a volatility trading and analysis perspective?
I mean, it's amazing how we have spun our wheels and gone absolutely nowhere all week. We've been up, down, nowhere. VIX is about the same spot. S&P about the same spot. VVIX is lower. It's just kind of shocking the way that volatility has just collapsed. And I'm impressed the VIX is over 12.5 right now with where realized vol is, which is, is there anywhere, can vol go anywhere below the toilet? What would be the next rung below the toilet?
The pipes, the pipes below the sewer.
It's in the sewer. Volatility is so low, it's in the sewer. It's not even in the toilet.
Well, yeah, if you look at our crystal ball picks from last week, all of us, including your cohort there, Andrew, we're all leaning aggressively lower than where we are right now. I mean, we're heading into a long holiday weekend. It seemed like post non-farms, unless there was a big surprise, it seemed like a recipe for a good old-fashioned volatility shellacking, and yet, at least so far today, that hasn't really materialized. Mr. Corner Office / Corner Studio today, taking over my whole studio here with his massive laptop. What's been catching your eye in today's and this week's activity, sir?
We're kind of expecting that volatility is going to be under a little bit extra pressure because we're in front of a 3-day weekend and we got one of the 3 major things behind us that we get each month in the form of the non-farm payroll number. Also, I really like to watch the CME Group's FedWatch tool. And right after the employment number came out, the odds of a rate hike at the September meeting went from like 26% to 18% automatically. So an adjustment like that, that's good for equities, bad for VIX, and then you've got the weekend headwind as well. But not only is VIX lower right now, all 29 of the volatility indexes we quote at CBOE are down. It's a rarity that you see all of them move in the same direction. We usually say 28 of 29 are up or down, but all of them are lower, mostly led by the broad-based equity market ones, which are under an awful lot of pressure, led lower by VXST.
Yeah, we've also been remarking a lot here on the program about that. Some may say, some listeners have actually written in to say exactly that, somewhat ridiculous premium we're seeing out there and the elevation in the term structure of the VIX Futures. It was exceedingly rich not too long ago, about 5 points between the cash and I think roughly the ACH future time span that has, of course, come in a little bit, perhaps not as much as some might like. It's still about a 3.5, 3.3 points, depending on where you're looking out there in the term structure. So things are pretty rich. As Mark alluded to, VVIX still kind of where it's kind of almost been a copy and paste week after week the last couple of weeks. It hasn't really moved. It's been hovering around that 85 or so level, right near the bottom of its kind of near-term trough there, which is a floor of somewhere around the 75 level, and it hasn't really budged. So there have been a few developments from a vol perspective over the past few weeks, and yet VVIX not really resonating to any of them, kind of sitting in that level, which is kind of interesting as well. So there's a lot of head scratching to be done right now, and since we're coming up against it, let's just dive right into everyone around the globe's favorite segment. It's time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
I get the exquisite pleasure, listeners, of watching Russell dance to his own music here and bop his head in the studio, which if you haven't seen it live, I recommend you do at least once on the old bucket list. That said, Mr. Corner Office, what's been catching your eye in a weekly VIX options perspective this week?
We'll periscope my...
there we go.
My dance.
That will be terrifying to all of our audience.
We actually have some activity in the September 7th options, which do settle on the open next Wednesday, which is about 1.5 trading days from right now, since we've got the 3-day weekend. Somebody was selling a bunch of the 13 calls for 45 cents, and somebody with a very similar outlook is buying a bunch of the September, gosh, I'm still stuck in last month. The September 7th, 1350 puts, they're paying 50 cents for those, so they're looking for a VIX settlement under 13 if they hold that into expiration. And this is my favorite trade from the weekly arena.
We need a little music for that, too. The favorite weekly trade. Dun, dun, dun.
No. It has to be Bob Marley music.
Oh. Why?
Because somebody bought 420.
So that's a very specific 1 week's worth of music. You never use that again.
Yeah. So unless there's somebody that's always trading a 420 lot, somebody bought 420 of the September 7th 15 calls for a nickel. So hey, that's 1 day. We get a
that's a daily. We're already talking about dailies coming. There you go. There's your daily.
And I did want to interject a little bit about the SPX Monday weeklies. Last Friday, we actually did 50,000 of those, which I think is pretty impressive. We've done about 30,000 of those today. And somebody, the conspiracy theories are going to abound if this trade pays off. These options expire Tuesday on the close, so you literally do just have 1 day to go. Somebody bought 7,000 of the 2025 puts for a nickel. That's 150 points lower.
Wow.
Just first thing this morning. That's, maybe they thought that these were leaps that expired in a year or something. But
wow, these are really cheap leaps. Maybe that's the same guy doing the 420 lots. He might be a little confused.
He did his 420, and then he went out and bought these.
And then he bought 20,000. Instead of having the proverbial munchies, he had the teeny putties. And he had to just gobble those bad boys up. Well, yeah, it's been interesting. I'm glad to see the weeklies were lighting it up. It was kind of the only thing that was kind of lighting it up this week. The rest of the week, the old VIX mothership, kind of an anemic volatility or volume week. Kind of today was notwithstanding. Today actually doing some decent paper, about 438,000 contracts. So it looks like it'll hit the ADV right around 600,000 today, thanks to our friends over there at the non-farms. But other than that, not a heck of a lot to parse from an overall volume perspective this week out there in VIX options. Previous weeks, we've had some narratives. There were bullish risk reversals going up. There was combos versus calls last week. Not really much of a narrative. I guess if you can find one, maybe a bit of a head scratcher, aside from your 420 puts there, Russell, looks like a bit of there was some, of course, coming in on the heels of this morning's number. We saw some people giving up the ghost for size and the upside there in SEP, with people dumping about 80,000 plus SEP 18 calls for 35 cents, just crushing the bid as soon as they could, saying, yeah, these are going nowhere fast, and I'm getting the heck out of Dodge on these bad boys. So some people, at least in the near term, have thrown in the towel. Not surprising. If you can still get a bid on those 18s right now, given where all of us are leaning in the crystal ball, you probably want to take it and get the heck out of Dodge. Some of the weirder trades we did see going up this week, and maybe, Russell, you noticed this one as well. It would look like a funky, I guess what you can call it, a time stupid. It was a SEP OC 20 time stupid. It went up, going up on Thursday for 26,000 by 20,000 on the 20,000 on the SEP, 26,000, excuse me, on the OC. I think might have been an opening sale. Then we did see a similar paper going up today, but not exactly. It looked like it might have been closing buy at first, but today it was the 21s. It was a SEP OC 20, SEP 20 OC 21 strangle going up, lifting offers today, or I should say time stupid, 16,000 times. So weird time stupid / strangle / call it what you will paper going up on both of those months and around the 20 strike over the last couple of days. If it was just the stupid going up on Thursday and then buying it back today, that guy did all right. He made about $500,000, but that's not the case. It's not exactly what he put up. It was actually the 21s going up today. So a little bit of a head scratcher out there as well. A lot of weird paper going up this week, but not a lot of size, so we won't get too much into it. Instead, we'll actually come up against it, so we'll just even push past the hot strikes. Spoiler, there were only 2 puts on the top 10 this week, and the number one with the bullet, the SEP 20s with 308,000. So maybe the 20 strike has finally usurped the beloved 30 strike that everyone can't seem to get away from, even though the 30's still on the list, Mr. Rhodes, with on the number 10 spot yet again with 156,000 contracts open there in the SEP 30. So people still liking themselves the 30 strike, even though not as much as the 20s apparently, which is certainly a reasonable perspective to have these days, sir.
On the September-October trade, I actually got a note from one of the par officials down on the floor, and it doesn't look like it was as stupid. It actually, it appears that they sold the SEP and bought the OC. That
would make more sense.
Yeah,
when it was first told to us as a stupid, it kind of sounded odd, shall we say? But I don't want to besmirch people who tell us these things. But still, it's we didn't have time to really dig into it right before the show. But it did seem a bit odd. Today's paper was indeed looks like a lifting on both sides. So today's, or I should say Thursday's paper, I think was a bit funky. But yeah, either way, it's interesting. But yeah, it seems like that trade. That SEP-OC trade around that 20 strike has been kind of active and pretty juicy for the last couple of weeks. So people doing it as a spreads, clearly, apparently, at least some of them doing it as a stupid as well, and going back and forth, buying SEP, selling OC, and vice versa. A lot of interesting trade there to be found as we keep on rolling. We don't have time, listeners, for skew, or we don't have time for gold or crude. Even your questions. We got one in with Ricardo there at the top of the volatility viewpoint. But you have to keep on rolling to our final segment, listeners. It's time for us to embarrass ourselves horribly because, yes, it's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, it's time for our final segment, the crystal ball. This, like the man said, the portion of the program where we all prognosticate wildly and indeed recklessly on what the volatility gods hold in store for us for the week to come. So exactly this time next week. And all of us, including your cohort there, Mark, Mr. Rock Lobster, we're all leaning lower. I was leading the charge to the downside. I was picking about 11.5 right now in the VIX cash. I thought for sure there would be the shellacking, the drubbing, call it what you will, post non-farms, holiday weekend. It seemed like a perfect 1-2 punch here for vol for this weekend. And yet, as we're recording, VIX cash actually ticking up a little bit, about 12.65 right now. So bouncing off that 12.5 level. So apparently there are people who still want themselves some vol heading into a long holiday weekend at a time when realized vol is 5. So hey, apparently there are some buyers out there, which is interesting in and of itself. Russell was the next lowest with 1190, and then Andrew was, I guess, the winner, even though none of us really won this week. He picked 1210, so he was the closest without going over by Price is Right rule. So he wins. So that means since he's your cohort, you got you have a kid, Mark. You get to sit back a little bit and let others pick volatility for you. And lo and behold, you actually get the winning seat. I'll give it to you. I'll give it to the option pit seat today. So you get the choice, the winner's choice, Mark. Do you want to go first, or do you want to pick someone else to go first and you go last?
I'll go first. I'm gonna pick 12.5.
So pretty much almost unched from where we are right now a week from now. Huh? Interesting. Yeah, that could, given what's been going on lately and people's propensity to decide to buy almost regardless of what else is going on in the marketplace, I certainly can't fault you for going that high. Mr. Rhodes, you came in next, so you get to go next. What are you feeling next week? Higher, lower? Are you going to go back to your vol buying ways, 15, 16.5? What are you feeling?
Gosh, I'm not going 15, 16.5. What are you going to say before I say something?
Well, you came in next. You go next. Okay. It's your turn, cheater.
No, that's, trying to get you to tip your hand a little bit, and
you're not. I'll give you a hint. I'm going lower than Sebastian, if that helps you.
Oh, then heck, I'm 12.51. I'm not going to do that to him. I was actually going to say 12.99 before. I think we start to get a little bit of a crooked handle because we are coming up on a treacherous time of a year. And, I know that nobody's concerned about how the election's going to work out in the U.S., so that's not going to impact the markets at all, right? Right. So, no, I wouldn't be surprised if we start to work our way higher. Again, being in the mid-12s in front of a holiday weekend like this, it's actually, and with realized vol down in the 5s, I mean, we're actually kind of elevated. So I think it would take very little to get us moving higher.
So you can be buying those 18s. All the guys who were dumping the 18s today, you're like, take them, give them to me. So what is your actual number, sir?
12.99.
12.99. Look at you. You always have been a little rich on the vol side, and you are once again not failing to disappoint, sir. But you're right. This certainly does give pause to someone like me who does want to cut a lower number here today, because you're right. They're certainly not crushing this vol the way anyone would have thought. If any time was the time to sell vol, you would think, giving all the other indicators, it would be right now, and yet it is not materializing. So that does give me pause, but nonetheless, I shall pick. I'll go a little bit richer than last week, just because I was clearly too aggressive on my vol selling prediction last week. I'll go 11 in the orders, 11.75, and we'll see. We have a nice little spread now, 13 almost to the upside, 12.5. Mark kind of Goldilocks in the middle, and me 11.75 to the downside. Good stuff. As we come to the conclusion of this epic journey that is the Volatility Views program. That music means we're done, listeners. What an epic foray it has been. I want to thank our guest, Ricardo, from MSCI, for joining us on the program. Again, if you want to learn more about what they're talking about, head on over to the CBOE microsite to search for CBOE and MSCI, or just head on over to MSCI.com to learn more about the indexes that they disseminate over there. A lot of cool stuff, and hopefully a lot more coming out from them in the options and volatility space very soon. Speaking of the options and volatility space, Mr. Corner Office, a.k.a. Corner Studio, what is coming down the pike in the land of CBOE and live vol?
We got a level 2 class next week on Thursday and Friday. Then the week after that, we're actually doing the second of our focus classes, focus on income trading, which is a little different than what we talk about on this program. We did have a successful focus on volatility class a couple of weeks ago. I had a baker's dozen show up for that class. We had 13, so...
Impressive. Auspicious numbers, sir.
Yep.
Considering that you charge $75,000 for that class, it's an impressive amount.
I do not charge that much for that class.
All right, and last but not least, Mr. Greasy Meatball, what is cooking in the land of Option Pit as well as all things Carmen Line?
I'm going to be speaking at the All-Star of Options here in Chicago, middle of the month. And then our next Saturday class, which will be at the end of September, is actually going to be trading daily options. So we're going to start looking at how to trade these daily listed SPX, SPY options, and try and give people some tools to trade these things as they become more and more listed. There will be daily options every day of the week in SPX. My prediction before the end of Q1 in next year.
There you go. Ending the show with more predictions. I like it. And of course, on behalf of the Greasy Meatball and Mr. Corner Office / Studio, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, for sending in such great questions. Unfortunately, we only had time to get to one this week. We'll get to more next week, I promise you. Also, thanks to everybody who tuned in live. Love to see you guys in there as well. Every Friday, noon Central, 1 p.m. Eastern. If you can, join us via Mixlr, MIXLR. We'd love to see you in there. And we'll, of course, see you next week for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.